My dear students, welcome back to our channel. In this video, I will be explaining the Bachelor of Commerce 6th semester subject Accounting Standard as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 1, the important short question is: 1. What are accounting principles? Accounting principles are basic rules and guidelines that help in recording and reporting financial transactions properly. They make sure that accounts are clear, correct, and easy to understand. Example: imagine you are keeping a record of your pocket money. If you always write down what you receive and what you spend in the same way, it becomes easy to track. But if you change your method every time, it becomes confusing. Accounting principles help avoid this confusion for companies. Some common principles. Going concern, business will continue to run in future. Consistency, use the same method every year. Accrual principle, record income expenses when they happen, not when cash is received or paid. Easy tip to remember. Think of accounting principles like traffic rules for money. They help businesses move smoothly and safely on the road of finance. Next important short question is: 2. State the limitations of accounting standards. Accounting standards are helpful, but they also have some limitations. They can't cover every situation or fit all businesses perfectly. 1. One size doesn't fit all. All businesses are different, but accounting standards are the same for everyone. Sometimes, one rule may not suit every type of business. 2. Can't stop window dressing. Smart companies may still hide their real profits by playing around within the rules. 3. Too many rules, less flexibility. Sometimes accountants can't use their judgment because the rules are too strict. 4. Not updated quickly. Business trends change fast, but accounting standards take time to update. Example: if a small shop and a big IT company follow the same rules, it might confuse the small shop owner or limit his freedom to show things differently. Easy tip to remember. Accounting standards are like school uniforms. They bring discipline, but not everyone feels comfortable in the same size. Next important short question is: 3. State the procedure for issuing accounting standards. Procedure for issuing accounting standards. In India, the Institute of Chartered Accountants of India, ICAI, issues accounting standards. Here's how the process works, step by step. 1. Identify the need. ICAI finds out if a new accounting standard is needed or if an old one needs changes. 2. Draft is prepared. A rough draft of the standard is created with all the rules. 3. Public feedback. This draft is shared with experts, companies, and the public for suggestions. 4. Changes made. ICAI makes changes based on the feedback received. 5. Final approval. The final draft is sent to the National Financial Reporting Authority, NFRA, and Ministry of Corporate Affairs, MCA, for approval. 6. Official release. Once approved, the standard is issued and companies must follow it. Example to remember. It's like writing a rulebook for a game. First it's written, tested, improved, then published for all to follow. Tip: remember the word draft, discuss, review, approve, finalize, tell everyone. Next important short question is: 4. What do you mean by concepts and conventions of accounting? What are concepts and conventions of accounting? Accounting concepts and conventions are like the basic ideas and habits used while recording business transactions. They make sure everyone follows the same path in accounting. Accounting concepts. These are rules or assumptions followed while preparing accounts. Example. Going concern concept, business will continue in future. Money measurement concept, only money-related things are recorded. Accounting conventions. These are practices followed by accountants over time. They are not strict rules but commonly accepted habits. Example. Conservatism convention, expect losses, not profits. Be safe. Consistency convention, use the same method every year. Easy example. Think of it like cooking. Concepts is equal to recipe rules. Conventions is equal to grandma's cooking tips passed down over time. Easy tip to remember. Concepts are rules and conventions are habits in the world of accounting. Next unit 1 important long questions. First important long question is 1. What do you mean by accounting theory? Write about its features. What is accounting theory? Accounting theory is a set of ideas and rules that explain how and why accounting works the way it does. It helps accountants decide what to record, how to record, and how to present financial information in a clear and honest way. Think of it as the brain behind accounting. It gives reasons and logic for all the accounting practices we follow today. Example. Imagine you are playing cricket. There are rules, but also strategies behind those rules. Accounting theory is like the strategy that explains why those rules exist. For example, why do we record assets at their cost price? Why do we follow the going concern concept? The answers come from accounting theory. Features of accounting theory. 1. Explains principles. It tells us why we follow certain accounting principles and concepts. 2. Helps in decision making. It gives a base to accountants and companies to make correct financial decisions. 3. Improves understanding. Makes it easier to understand and explain accounting standards and methods. 4. Adapts to changes. It changes and improves as the business environment changes, like GST, digital payments, etc. 5. Based on logic and evidence. It's not guesswork, it is based on studies, facts, and observations. 6. Helps create standards. New accounting standards are created based on strong accounting theories. Easy tip to remember. Think of accounting theory as the Google Maps of accounting. It shows the right direction and explains why we should take that route. Next important long question is 2. Classification of accounting theory. Accounting theory is divided into 4 main types based on how it is developed and used. Let's understand each one with simple examples. 1. Descriptive accounting theory. What it is, it explains what accountants actually do in real life. Purpose, describes current practices without judging them. Example, if most companies record assets at cost price, descriptive theory just observes and notes that fact. Tip, think of it like a news reporter, just tells what is happening, not what should happen. 2. Normative accounting theory. What it is, it suggests what accountants should do, it gives opinions on the best way. Purpose, recommends better accounting methods. Example, it may suggest recording assets at market value instead of cost, if that gives a more accurate picture. Tip, like a teacher giving advice, this is how it should be done. 3. Positive accounting theory. What it is, it explains and predicts accounting behavior using real-world data. Purpose, tells why companies choose one method over another. Example, Why do some companies show higher profits? Positive theory uses data to find the reason. Tip: like a scientist doing research to explain why something happens. 4. Pragmatic accounting theory. What it is, it checks whether a method works well in real life. Purpose: focuses on usefulness. Example: if showing profits in a certain way helps investors, then it supports that method. Tip: like a tester, if it works well, use it. Easy trick to remember. Don't neglect practical points. Descriptive, normative, positive, pragmatic. Next important long question is 3. Deductive and inductive approach in theory formulation. Deductive and inductive approach in accounting theory. When we develop accounting theories, there are two main ways to do it: deductive and inductive approaches. Let's understand both in a simple way. 1. Deductive approach. What is it? This approach starts with general ideas or principles and then applies them to create specific accounting rules. How it works? Step 1. Start with basic assumptions or concepts. Step 2. Apply logic. Step 3. Develop accounting rules or theories. Example. Start with the concept that a business will continue going concern. From this, we create the rule that assets should be shown at cost, not market value, because we are not selling them right now. Tip: think of it like top-down thinking, from theory to practice. Easy example to relate. Like a math formula. You learn the formula first, then use it to solve sums. 2. Inductive approach. What is it? This approach starts with real-life observations and data, and then forms general theories from them. How it works? Step 1. Collect data from companies. Step 2. Look for patterns. Step 3. Create a theory or rule. Example. If you observe that 90% of companies record expenses as soon as they happen, you form the theory of accrual concept: record income expenses when they occur, not when cash moves. Tip: think of it like bottom-up thinking, from practice to theory. Easy example to relate. Like a detective. You see the clues, data, then figure out the rule, theory. Easy trick to remember. Deductive is equal to definition first. Inductive is equal to information first. Both approaches are used to improve accounting theory. One starts with logic, the other with experience. Just like in real life, we need both smart ideas and real-world practice. Next important long question is 4. Discuss briefly about list of accounting standards in India. List of accounting standards in India as. In India, accounting standards as are issued by the Institute of Chartered Accountants of India, ICAI. These are like rules that guide how companies should record, report, and present their financial information. The aim is to bring transparency, consistency, and comparability in the financial statements of all businesses. Total accounting standards. There are 32 accounting standards in India, but not all are mandatory. Some are withdrawn or merged, and only a few are applicable to all businesses. Important accounting standards, with simple meaning. As no. Name what it means, simple words. As 1. Disclosure of accounting policies, tell clearly which methods are used in accounting. As to valuation of inventories, how to calculate the value of stock. As 3. Cash flow statements show the cash inflow and outflow. As 6. Depreciation accounting, how assets lose value over time, merged with as 10. As 9. Revenue recognition, when and how to record income. As 10. Property, plant and equipment, how to record and show fixed assets like buildings, land. As 11 effects of foreign exchange handling transactions in foreign currencies. As 12 government grants how to show help money received from the government. As 13 accounting for investments how to record shares, bonds, etc. As 16 borrowing costs how to treat interest on loans. Easy tip to remember. Think of each as a chapter in an accounting guidebook. Each one teaches how to handle a specific part like cash, assets, stock, or income. Example. If a company gets a loan and pays interest, as 16 tells how to show that interest in accounts. These standards help everyone, students, accountants, companies speak the same accounting language. Next important long question is 5. Define accounting. Explain the evolution and accounting as an information system. What is accounting? Accounting is the process of recording, classifying, summarizing, and interpreting financial transactions of a business. It helps to know how much money a business is earning, spending, saving, or losing. Simple definition. Accounting is the language of business. It tells the financial story of a company. Example. If you run a stationery shop and write down all your sales, purchases, and expenses, you are doing accounting. Evolution of accounting, how it developed over time. 1. Ancient times. In India, accounting started with keeping basic records on palm leaves and stones. Merchants used local methods like Bahikhata. 2. Double entry system, 1494. An Italian named Luca Pacioli introduced the double entry system, where every transaction has two sides, debit and credit. This is the base of modern accounting. 3. Industrial Revolution, 1800s. Big businesses needed better records. Accounting became more detailed and professional. 4. Modern accounting, 20th century. Companies started following accounting standards and using computers for accuracy. 5. Today, digital and global. Now accounting is done using software like Tally, Excel, and ERP systems. It's faster, accurate, and globally accepted. Accounting as an information system. Accounting doesn't just record transactions, it also provides useful information to people like owners and managers to make business decisions, investors to know if the company is profitable, government for tax purposes, banks before giving loans. So, accounting works like an information system. It collects, processes, and gives useful reports just like a computer system. Easy tip to remember. Accounting is equal to business ka report card. It tells how the business is performing, just like your school mark sheet shows your performance. I hope you understand easily each question. All the best, students, for your upcoming exam. For other subject, quick revision. Important questions. Previous question papers. And syllabus. Links are available in description. Check out once. Thank you for watching. Like and share this video with your friends.